All takes us to our talk of the tape. How best to navigate a market spooked by late cycle ghosts, running into seasonal headwinds, and distracted by political static. Let's bring in Eric Johnston of Cantor, Fitzgerald, Shannon Saccocia of NB Private Wealth, and Kristina Hooper of Invesco. Shannon, a CNBC contributor, all joining me here. Great to see everybody. Eric, want to just focus on your take, which has for a while been flagging downside risk to the economy and markets that maybe aren't prepared for it. So what are you seeing, I guess, right now that's developing that you think might make stocks a tough trade?
Sure. So I think the backdrop of valuations at essentially the second highest we've seen in 150 years since the beginning of data. You've got the individual investor, which essentially is the longest they've ever been in equities. And to your point, what's going on in real time is the economy is slowing. So the economy has been slowing down from a payroll perspective and other perspectives for about the last, call it 4 to 6 months, but it's really started to accelerate, and we're seeing it across a number of different factors. Clearly, the labor market, unequivocally is slowing. We are seeing delinquencies rising. We saw some of that today within the financial sector, and a whole bunch of other economic indicators are suggesting the slowdown. So I think the key is, why are we slowing, and are those things going to change in the coming 3 to 6 months? And our answer is we don't think so. We think the three biggest things that are essentially impacting the economy and causing the slowdown are that excess savings are declining. We don't see that changing. Prices are simply too high. Right? So we've got an inflation rate that on a month-over-month basis is down to 2%. But right now we're about 12% above trend for the CPI, and that's causing problems. And then the third factor is restrictive Fed policy. That's going to get less restrictive, but we're still going to be, we think, at least 200 basis points above the month-over-month annualized inflation rate for at least the next 4 to 5 months. And then, oh, by the way, you have China, which is 17% of global GDP. That is a drag. Mm-hmm. So I think it's a tough environment.
Well, slowing, Shannon, is something almost nobody disputes, right? We're coming off of above-trend growth for a while, and the question is where we're settling out. And we've seen cyclical parts of this market actually soften up quite a bit. So in other words, the market's seeing this happening, and the question is, can we pull out of it or can we muddle through? And how would you think about investing given the opportunities that are in front of you right now?
Well, if you're thinking about this being softening, we're really thinking about it in terms of a normalization. I think that's what the Fed's talking about, right? And so you can't have a landing without some sort of landing. And our view is that there are a number of areas of the market, particularly when you look at valuation, but more importantly, when you look at accelerating earnings growth. If you look at the differential between what you're seeing in the Mag 7, for instance, you're actually seeing declining earnings growth. And, I think that's been, well telegraphed. But if you look at some of those more cyclical parts of the economy, financials, healthcare, which interestingly has become a bit of a cyclical now with some of the megatrends that we're experiencing, utilities, REITs, those are areas that are not only going to benefit from a lower rate environment, but also we do see some disinflation benefits to those companies, and therefore kind of setting the stage for accelerating earnings growth, even with sort of, I would say, at-trend growth, not necessarily some of the stronger growth that we've experienced over the last 5 or 6 quarters.
Kristina, it seems like when you have a Fed that has essentially told you it's going to begin an easing cycle next week, it sort of concentrates this debate on whether it's hard or soft landing, whether it's just in time or a little bit too late or whatever it might be. How does the CPI number tomorrow play into that, if at all? And where do you think we are in terms of just how high the stakes are for how big a rate cut and how the Fed handles this?
So I think the CPI number is a lot less important than any number of data points that give us a sense of the economic health of the United States. And so while it will matter, it won't matter very much. And quite frankly, I think what we're going to see next week is a Fed that gives us a 25 basis point rate cut, because to give us a 50 basis point cut will set off alarm bells and would also be an admission of guilt. So what I would say is I don't think that the Fed keeping us at very restrictive monetary policy levels for a long time creates damage that is irreparable. But I do believe every day we have rates at these levels, the odds of a recession increase. I think we can avoid that. But that means the Fed has to telegraph, probably through the dot plot, that we are headed for more rate cuts sooner rather than later, and that we are still sitting on a very solid economy based on their growth projections.
I mean, you don't think that, given that they are conceding that policy's been restricted for this long and that there's a pretty wide distance between where rates are and where they think neutral is. I mean, even the market right now is projecting a terminal rate below 3% for Fed funds. We're at 5.25 plus right now. You don't think that given all that, a 0.5% move next week would simply be, look, we're taking a larger down payment on what we ultimately have to do?
I think it would be a red flag. Let's look at March of 2022. The Fed knew it was behind the curve in terms of fighting inflation, but it only hiked 25 basis points. It followed up with 50 and 75 basis point hikes, but the start was slow. And I think to do otherwise suggests problems.